Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update for today, Monday, starting the week, 10th of July. We don't have any big economic data today. We have a bunch of Feds, though, and we are going to review their statements as always, focusing on inflation, services, and economy. And we have Fed Bar, Fed Daily, Fed Mester, and also Fed Bostic. 4 Feds talking today, and that's why we are seeing such choppiness in today's market. So without hesitation, let's go and let's jump into the presentation. So as you can see, 10th of July statements, we are going to start with Fed's bar. Inflation is far too high. That's obvious. They are acknowledging that. But the recent moves on rates are part of a process to move in a careful way. They are focusing on 25 basis points, small steps, and maybe pausing, increasing, going slowly in a careful manner to really see the signs of that restrictiveness, taking into consideration the lag that this hike in rates have through the economy. Rates are close to restrictive, but the Fed still has work to do. Mester will need to tighten further to lower inflation. Raising rates again will reduce the risk of more action in the future. Business leaders' worries of recessions have declined because obviously we are seeing signs of strength in the economy, and the economy has proved stronger than they expected. Demand for labor still stripping supply, and wages pressure remains too high. Wages pressure, that's why we are focusing more than ever on non-farm payrolls. Core inflation gains are too high and too broad bases. Be careful. With core inflation is the focus. The economy would be better off if the federal fund rates go higher, and she's not seeing signs of excessive credit tightening. So going in the same direction, tightening further, wage pressure, core inflation, increasing rates. Fed's daily, inflation is pretty too high and we need to keep raising rates. Again, the same message as the other two. We are likely to need a couple more rate hikes. Today, with labor market still strong, inflation high, risk of doing too little are outweighing the risk of doing too much. They prefer to just go ahead and be at higher enough restrictive interest rates than doing too little, because we learned from the past, from the history, that in the past we didn't bring too much the interest rates high enough, and we started cutting rates in the past too early, and well, that didn't work, and we had to increase again after some pauses. So they don't want to fall in the same issue, because we learned from the history, and right now risk of doing too little are higher than doing too much. They prefer continue hiking, and then if we start seeing signs of economy slowdown, they can cut more aggressively. That's their approach. There are longer lags than we assumed, and we may end up doing less or more than a couple rate hikes this year, depending on the data. Data driven. Fed is data driven, as always. I don't think rates are restrictive so far, so more hikes. And the last services inflation print is good, but it was just 1 month. We need to see progress. And the last one, Fed's Bostic. In many regards, US is still in a pandemic economy, and a lot of the strength is due to the pandemic support. Remember, Federal Reserve printing money, so we are still today seeing the consequences of that support. Inflation is too high and not sustainable. Obviously, inflation is one of the most dangerous issues in an advanced economy, and it's not sustainable for society, for citizens, and also for the own economy. A recession is not the baseline outlook. This is quite happy to see, because they basically think that they are not going to enter recession. It's not their primary outlook, and the economy is starting to slow down. but with job growth slowing down and inflation coming down, among other signs. But remember the wage pressure that Mester was saying. Businesses still hiring rather than preparing to lay workers off, indicative of resilience. So this is the actual statements from the Fed. Let's now go jump to the charts to see what we got today regarding price action. Remember, we first start with the daily, and the daily, as I was explaining in last weekend's video, this topping tail candle is not looking good, and we are right now bouncing off last week low, that is this blue dot line. And if we check slower time frames, for example the 4-hour, we can see that we sold off today and we are bouncing up. But overall the strength, this is the 30-minute chart, overall the strength of the Nasdaq is not as expected. This was Friday sell-off, continuation into overnight today, reversal right before the open. And look at this choppiness. Let's see the 1 minute, because this is insanely choppy. We moved up, we tested pre-market highs, really critical level. We start seeing some wicks and we sold off. Then we reversed first to pre-market high again. We start chopping around, then go down, we go up. This is all due to the Feds speaking, several messages going through the participants, and also because we are waiting for the CPI this week and also PPI. So it's obviously just a day of distribution, basically consolidation. At least we are seeing some buyers in the 30-minute and the daily time frame with this bottoming tail. But despite the fact that it's red candle, at least we are seeing some support down here. Look at this bottoming tail in the 30-minute chart. So the 1 minute super choppy. Today is a really, really dangerous day to really trade on the 1 minute or even trade at all. So I just took some shorts, then this reversal, just scalping the day, but this is not worth for me. So I'm better for waiting for tomorrow and Wednesday to see actual progress due to economic data like CPI and PPI. What else? If we check the core list of tech stocks, Apple is minus 1.40% on the day, gapping down in pre-market and continuing lower. Really weak. Microsoft 2% in the red, gapping lower and continue lower after the open. Tesla is minus 2.30. This was one of the things that I was watching. Look at this gap. This was presented in the weekend's video. Gap fill, gap down fill, almost to the tick. So we are almost filled in Tesla with this gap. And this is beautiful to see, because if we end up being bouncing from the gap fill on the daily, we might see some progress to the upside throughout the week. Tesla had this gap really near, and basically it's now repaired as far as I understand it. Amazon quite green, also minus 2.32. Look at this, really selling off right into the open. Google minus 2.61. So we are red across the board in every stock, big stock, Nvidia. But Meta is 0.15. We were right there, almost 1.5%, and we were trying to continue filling this gap, but it was quite rejected, almost triple top. In the 1 minute chart, we can see that we tested that right into the open, 1, 2, 3, 4, 5 1 minute candles, and basically it got rejected. So tech stocks quite weak. ES is actually holding, and the reason why is because the banking sector is really holding pretty nice. And basically it's because we are going to see the first earnings this Friday before the open. We have JP Morgan Chase, we have Citigroup, we have Wells Fargo, and we have BlackRock. Until then, everything is speculation. I think a lot of people is going to bet on banks doing pretty well, pretty good. So part of the reason why the Nasdaq is seeing this pressure is because obviously the Nasdaq is not, banks are not part of the Nasdaq, but it is part of the S&Ps. And we are seeing these divergences on the strength today. Nasdaq is minus 0.20 and the S&P is actually in the green, 0.08. And we check the daily, we can see that we are putting a basically doji bottoming tail in the green. So we can remove this bounce of the Fibonacci retracement quite good. So banks are in the green, sector funds, consumer discretionary basically flat, financials doing pretty good. And I'm expecting continuation until Friday, until we see actually the first earnings of the big banks. And something that I would like to note is that dollar is seeing a little bit of continuation to the downside, and this is putting more pressure into stocks and into the overall market. Seeing this big red candle on Friday and seeing this continuation now below the ascending support, if we close down here, I mean, there's a high chance, high probability of basically retracing to 100. And down here, I think buyers will commit again. That's my approach, my understanding. Yields, the 2-year yield is seeing a little bit of pullback, 2% in the red, same as the 10-year, basically rejecting this SBB zone level that we approach, quite dangerous. So it's good to see yields going lower. High yield corporate bonds are 0.56, not really risk on, but at least we are seeing some push to the upside in the risk on assets. Treasuries are in the green. Look at this. At these levels, I think treasuries are quite good. And finally, Russell 1.50. Russell is really pushing today pretty nicely. Look at this. Small caps are doing pretty good, and the same for Bitcoin. Bitcoin 0.50, seeing some nice uptrend, and on the daily, we are seeing again consolidation of this zone that we have up here, basically this range around here. We don't close up nor below out of this range. So if you are trading Bitcoin, my recommendation is to be patient until we close out of this range. Coming back to the Nasdaq to see if anything has changed. Nothing. We are trying to be in the green basically, but Apple, Microsoft, Tesla, Amazon, Google, all the big tech stocks are deeply in the red. And if we check the economic data, I think most participants are really waiting for the big information, not tomorrow, but on Wednesday. Inflation rate on CPI on Wednesday, and on Thursday, PPI, Friday, consumer sentiment. So I think you have to really be patient this week. You have to really manage your risk, do some scalps, or wait for momentum to decide in certain stocks and certain indices, because we are chopping around. As you can see in the Nasdaq, it's quite weak. If you are trading DS, same thing, a little bit of moves, but basically just playing the range and chopping around with a lot of volatility and a lot of choppiness. So this is not work for me. It's better to just wait for the economic data and react to those numbers. And that's all from my side. As always, thank you for your time. If you found this video useful, please support the channel, give it a like, and subscribe if you want to see more videos. Thank you. As always, remember that discipline and risk management are key for your success. Stay safe, everyone, and see you tomorrow.